Justin looks as though he's actually dropped off.
He can come back in though. Is he letting people in?
Yeah. How weird. No one's come in.
Should we text him?
I have.
Okay. Since it's actually 10 o'clock.
Oh, he's back. Please, Justin's mute button's on then.
Sorry, it logged me out. It's all our members are coming in.
Okay, thanks, Justin. Morning, everyone. We'll just wait for a few more people to come through to the seminar so that we can start off today. My name's Paul Lynch. I'm from the National Relationships Manager from the Australian Catholic Super and Retirement Fund. And today we're going to run through a retirement planning seminar that we normally used to run and would prefer to run this face-to-face, but obviously with the world we have today, we're doing this online. Today we've also got Sonia White, who is our financial planner from our Brisbane office, and she will be running through and we'll be both giving you some information in regards to what you need to prepare for retirement. So Sonia, welcome and thank you for attending today.
Good morning, everybody. Thank you, Paul. Good to be talking with you.
In terms of the session today, we need to start with an acknowledgement of country. I would like to acknowledge the traditional custodians of the land on which I work and live, and recognising their continuing connection to land, water and community. I pay respect to elders past, present and emerging. For those people that have attended a financial services presentation before, I always say that this slide really tests your preparation for retirement. If you can read it, well then congratulations, you're probably not ready to retire or you've got wonderful eyesight. Essentially, today's presentation is not financial advice. It is just general information that we are providing to you. We're not taking into consideration your own personal needs. And we're just really running through what we believe the general person needs to provide for retirement planning. So Sonia, a financial planner, is also covered under this disclaimer. Now, I would refer to members to the product disclosure statement and the target market determination that's placed on our website if you wish to have further information. But today, if you want to have ask questions in today's forum, you're more than happy to use the Q&A facility within the Zoom area. You might find this down the bottom or the top of your screens. If you put your questions in there, I'll keep an eye on those. And we may answer them during the session, but we've certainly dedicated some time at the end today to run through any of these. So thank you all very much for attending, and we appreciate your time that you've provided for us. In terms of retirement planning, each and every one of us, I would presume, would have different thoughts or requirements that we want to have for retirement. We may want to be traveling. I'm not too sure too many people want to do cruising these days, but I do note that it's appearing on the news. But certainly whether we're doing a high amount of travel or just being at home doing volunteer work and the like, that requires cost or income. So therefore, that determines your retirement goals and your funding for retirement. So Sonia, when you sit down with people, how do you actually go through and ensure that people have got the right requirements for their retirement plans?
I guess it's a conversation that takes many forms, because some people do have goals, but others don't, and depends on the stage they come to see me. But the sooner you can start planning for retirement, the better. The most common questions I get, how much will I be able to spend in retirement? Can I afford to retire now, or do I have to work another couple of years? So knowing your goals helps me work out whether you're on track to meet those or not. So if you get a tick, fantastic. If it looks like there may be a shortfall, you better know sooner rather than later. So we have discussions about what might need to be tweaked to help you get over the line.
For sure. And I suppose what people do ask you is that, well, how do I know if I've got enough? We always refer to a couple of items. Now, on your left is the full age pension. Now, this is what is currently being paid if you were being entitled to receive the full age pension. And we'll go through the requirements for that in a moment. The next two boxes is what we call the ASFA modest and comfortable provisions for retirement. And that's all provided in the retirement standard survey that is done monthly. Now, I always tell people, if you want further information on this, if you Google ASFA, that's ASFA, retirement standard, it should be one of the first ones to come up. And it is basically a review or a research on what people are currently spending in retirement. Sonia, would you mind just giving us a quick run through of what these symbolise and the differences between modest and comfortable and the factors that they've used to determine these figures?
Yes, certainly, Paul. People are surveyed around Australia, so it does take into account capital cities and rural places, and it's an average that people require based on different sectors as well. So we're looking at household expenses, food, clothing, entertainment, travel. Not a lot of travel, but there is some travel in the comfortable lifestyle and less in the modest lifestyle. What we know with these figures is that they assume that people don't have rent or a mortgage. If you have those expenses, they're going to be on top of these costs of living. And there's actually very detailed breakdowns of what's included in the modest lifestyle and what's in the comfortable lifestyle. And there's differences at, say, as an example, the healthcare level. If you are on a modest budget, you may just have hospital cover. If you're on the comfortable budget, you can afford the extras cover. If you have any questions around that, I'm happy to email anybody the link to the breakdowns, but they are on the ASFA website as well.
Thanks, Sonia. I suppose I always provide the example is that most people on the full age pension, you can see there receiving $38,000, or let's say 39, and a couple is on modest lifestyles around about 42. So there's around about $3,000 difference that you need to fund to go to the next step. So today, we're not talking about large sums of capitals. We could only be talking about a small amount of money. Sonia, there has been some research as to what sort of a lump sum capital you do need to fund a comfortable lifestyle. Can you provide some information on that?
Yes, Paul, there's a common misconception that people need $1 million to fund a comfortable lifestyle. That might be true if you're retiring early, but if you're retiring at 65 and assuming an earnings rate of 5% per annum on your investments or retirement savings, then a couple needs $640,000 approximately to have a comfortable lifestyle. It's assuming that you're eligible for the age pension, of course, which is going to supplement your own retirement savings.
Thank you. So I suppose if you want the details, as I said, Google the ASFA retirement standard and you'll be able to get all the breakdown of what the differences mean. I suppose one thing is that superannuation is a key item for most people's retirement planning, but we need to take more of a holistic review. And I suppose, Sonia, that's where we bring in further assets that are available to fund people's retirements.
Yes, not everybody has all of these, but if you do have things other than super, there might be a preferential or optimal way to use these assets in retirement, including the family house. That can be a source of retirement through reverse mortgages or the pensioner loan scheme. The way you draw down the assets in retirement will have tax impacts, estate planning impacts. So we take it all into account to help optimize people's situation.
Lovely. So I suppose the one thing is that we always talk about is well, why superannuation? And we have a colleague that talks about the tax nirvana world of account-based pensions. Now, obviously, when you have a superannuation account during your working life, you contribute to it, your employer contributes to it, you can do top-ups, you may salary sacrifice and the like. But once that investment's sitting in that superannuation account, the investment earnings are taxed up to 15%. Now, when we move all the way the end to the account-based pension, when you get a meter condition of release, and we'll go through those in a moment, it basically means that you have the eligibility, or you've retired as such, to start an account-based pension. The benefits of that is it's tax-free for investment earnings. So you'll see on our website, and I always highlight to members, if you want to have a look at the benefits, you can see that in raw percentage terms, is that if you have a look at our website, we quote the returns of our portfolios and the ones that are same between the both products. There is a difference in the returns, and it's simply and purely taxation. So there is certainly some benefits of accruing your superannuation or building your superannuation up so that when you do come time to retirement, you can look to purchase an account-based pension, and you can only use superannuation monies to purchase those. So that there is the benefits of accruing money in superannuation. And I would imagine, Sonia, it's becoming more and more common that super is your largest asset apart from your home.
Yes, absolutely, Paul, particularly with the changes that we'll talk about soon, that it's opening up the door for people to get more into super and take advantage of the tax benefits.
Certainly. So I suppose when it comes to, we talked about your condition of release or when you actually retire. The strange thing is I always start from the middle in this one, in this slide. If you cease work after the age of 60 years of age, whether it be a contracted position, you're part-time or full-time and you resign from your position, you have met what we call a condition of release. You then have the options of taking either a lump sum or the benefits of taking out an income stream like an account-based pension. Now, people that are still working at the age of 65, they do not have to actually resign from employment. They have automatic eligibility to have access to their superannuation account. So turning different ages or these milestone ages certainly means that there are different ramifications. Sonia, would you mind going through and explaining what we call transition to retirement with the first box though?
Yes, certainly. If you have reached your preservation age, but you're under 60, you can start a transition to retirement pension, but the earnings are going to be taxed. Where someone has genuinely retired though, and they need that pension to live on, there are tax rebates that kick in. So around about the $45,000 mark can be drawn out of super, provided you've got no other income. The $45,000 essentially comes out and is not taxed. If you have other income, however, there is tax consequences and it may not put you in a better position. Once you get to 60, however, that transition to retirement pension is tax-free. And there's some very good strategy we can do with transition to retirement pensions where you're able to take up to 10% of your balance and use it for things like increasing your salary sacrifice, reducing death benefits tax, or paying down your debt a bit faster. So certainly anyone 60 and over can benefit from coming and having a look at their super and how to make it work for you, even if you haven't met a condition of release.
For sure. And still the benefits of contributing to superannuation still exist. We talk about salary sacrificing as one option to contribute to super. Remember, when you contribute to super, it's taxed up to 15% on entry to the fund. The benefits here is that, as you can see, the average employee earning between 45,000 and 120,000 pays tax at 32.5 cents in the dollar. Now, if you're foregoing this income, instead of getting taxed at 32.5 cents in the dollar and only sending it to superannuation and getting taxed at just 15 cents, you can see the significant tax savings of salary sacrificing. But it doesn't work for everyone. And that's where you need to review year by year your situation to ensure that you are doing the right form of contribution. If you've stopped work and obviously doing the random casual day of work and not even earning up to the $18,200, if you're still salary sacrificing, we're still going to tax it, even though that had you received it in your hand, you would not have paid a single cent in tax. So salary sacrificing works for the majority of people, but we continue to say that it needs to be assessed for each and every one to ensure that you're gaining the benefits of it. In terms of the superannuation guarantee, we would note that from 1 July, it is now going up to the 10.5% on its gradual phase up to 12. So employers will be forced to contribute additional superannuation. So I suppose the one thing that people within superannuation world have been saying that 12% is enough to provide a reasonable account balance, but we always need to contribute a little bit more to make sure that we have an adequate retirement savings. Realistically, I'm going to only talk about myself, is that I've had a few runs on the board in terms of years of service, and I'm not going to enjoy the benefits of getting 12%, for all of my working life, not until the 1st of July 2025. So it's possibly only going to benefit our kids or grandchildren who start work for the very first day on the 1st of July 2025 to get this 12%. If you're like me, we will all have to probably address that and contribute some form to your superannuation. So, yes, the world is changing in terms of compulsory super. The government has addressed it and it's still on track to do that. But certainly, for some of us, we have missed the boat there in regards to this larger contribution rate. Now, we went through the benefits of salary sacrificing. Now, salary sacrifice, together with your employer's superannuation support, is what we call a concessional contribution. The current limit for this financial year is $27,500. And that's the limits there. Now, there are people that can contribute more. Sonia, would you mind just going quickly through the rules of those people that may be eligible to contribute more for this financial year, despite the fact that we've only got 2 more days left of this financial year?
There is the ability to put in a personal deductible contribution without needing to meet rules other than watching the cap. So we do have an annual cap of $27,500. For people who've been working casually or not salary sacrificing for the year, perhaps they're under that cap and can put in a top-up contribution and then provide the fund with a notice of intent, and that enables them to claim it on their tax. We do also have a rule that enables people with balances in super under 500,000 on the 1st of July to look back as far as 2019 and see if they had any unused cap along the way and carry that forward up to 5 years. That can give very powerful strategy for people, depending on their incomes, of course. But if you can reduce your marginal tax and only pay the 15% contributions tax, it can lead to significant savings.
For sure. So, and many people say that, well, look, I'm salary sacrificing with my employer. Excuse me for a moment. Excuse me. My employer and myself are contributing right up to the limit, so I can't put any more. Remembering there is the non-concessional contribution limits. Now, these two are also changing, but under currently up until 1 July, that if you're under 67 years of age, you can contribute up to $110,000 a year. You can bring forward 2 other years and contribute $330,000. Once you turn or are between 67 and 74, the work test applies, which means that you must be working for 40 hours over a 30 consecutive day period. Sonia, can I get you to run through a bit more of this slide?
Yes, certainly. So with the $110,000 per annum, that's a standard cap. Contributing that amount or less means that you haven't triggered the bring forward rule. But if there's a need if you've got more surplus funds and you want to use the bring forward rule, great care is needed, because in the subsequent 2 years, you don't want to go over the cap. It is a powerful way to get money into super, however, and there's exciting changes coming in. You can see that middle slide talks about a work test for people between 67 and 74, and it talks about the 110,000 cap only applying. That's changing so that people up to age 75 can not only put in a non-concessional contribution without meeting a work test, but they can also use the bring forward rule and put 3 years worth of contributions in. That is an enormous change, and it means for those who haven't been able to get assets outside super into super, now they can review that situation to see if perhaps that is in their best interest. Now, once you're 75 and over, no further contributions, of course, can be made by individuals, but employers may still be putting in contributions for you.
No worries. Thank you, Sonia. Bit of a coughing fit eventuated, but
You've done well so far, Paul.
I'm alive. So I suppose that there are other ways of contributing to superannuation. For those people who have a spouse that is low income earner, you can contribute money into their superannuation account to claim a rebate. If you want further information, there's information on our website, or otherwise you can give me a call. You can obviously consolidate your superannuation accounts together. So certainly, Sonia, would you mind running through the downsizer provision? You've mentioned it previously about people using their home to fund their retirement. Can you run through just quickly the ramifications of that?
Yes, certainly. If somebody sells a home that they have owned for 10 years or more, and they have lived in it, even if it's not for the full 10 years, so that home is partially or fully exempt from capital gains tax, they're able to put in a contribution without meeting a work test, and it can be up to $300,000 as long as you're not putting in more than the proceeds of the sale of that home. The downsizer rule is currently, and for the next 3 days, only for people 65 or over. From the 1st of July, you can be 60 or over and use this rule. And combined with the non-concessional rules, enables people to get a lot more into super if they wish. Also, the other point about this rule is you don't actually have to be downsizing. You might be upsizing. It's just triggering that condition is going to let you put money into super. Now, the trap around this is that the contribution has to be put in within 90 days of settlement. So you don't have very long to make a decision or restructure things. So it's worth getting some assistance with that if that's a consideration. We see members of a couple, even if the home was only in one person's name, they're able to both put in up to $300,000.
Lovely. And there's been a number of people that have utilised this feature, so it's quite a good feature, and it gives people a little bit more flexibility to boost their savings.
It sure does.
I suppose, Sonia, we're now moving into more of an area that you're going to provide information about what options you have in terms of lump sums or pensions and running through the pension. So I'll let you go through those. But before we do, I'd just like to remind people that if they do have any questions, they can use the question Q&A facility at the bottom or top of the screen, depending on their setup. So if you've got any questions there, we've got a couple of questions there parked, and I'll answer those when we come to the end there, Sonia. But yeah, anyone who has got any questions, please do not hesitate to shove them there through the Q&A facility. So Sonia, I'll get you, because I can feel as though another coughing fit will be coming on very soon. If you keep talking, I can go through and keep hitting for the next slide.
Thanks, Paul.
But essentially, we're up to the point of looking at lump sums or income streams, and then what are the options?
Sure. So firstly, we have people that have met a condition of release and people that haven't. If you have reached preservation age and have not met a condition of release, you can only access a transition to retirement pension. If you have met a condition of release after preservation age, then you have a choice of taking a lump sum or an account-based pension. People that take the pension option for regular withdrawals that are paid automatically, it's a lovely streamlined product. However, they can also take a lump sum out of that if they need to do house repairs, buy a new car, that sort of thing. So there's a lot of flexibility. So the super account is the window for getting money into super, and the pension account is the really convenient way to get money out on a regular basis after you have met a condition of release. The important thing about the pension too is that the earnings are tax-free. I have people come along that have met a condition of release, and that could be just turning 65. It could be that they've ceased a gainful employment arrangement but gone to work somewhere else, and they don't need the cash flow. There are still significant advantages potentially to moving money to a pension account though, and then doing something smart with the minimum pension that you're required to withdraw. Now, thanks to COVID, the minimum pensions are half the normal standard. So it may only be a small amount that you're required to withdraw to get the tax-free earnings, or perhaps you want to draw more than the minimum and be able to do some extra salary sacrifice. If somebody is 60 or over, I certainly think they should review whether their super is working for them and whether they've actually met a condition of release and can boost their earnings. Transition to retirement pensions. As we mentioned, if you have reached preservation age and you want to draw money out, the only way to do that is through taking one of these products. The difference is that the earnings are still taxed, but you can take up to 10% out. And if you're over 60, that drawdown is tax-free. So the kind of applications I use this for people that want to increase their salary sacrifice, so the round robin can get them significant tax advantages. I have used it for people that don't own their own home, and they may take out 10% in one financial year and 10% the following financial year, and that gives them enough for a house deposit. We also start strategies for those who want to draw or to reduce potential death benefits tax, which is the tax that's withheld if money's passed to adult children that aren't financially dependent. Thank you, Paul. The allocated pension product looks and feels like the transition to retirement pension, except that there is no maximum. The maximum falls away. You can take whatever you like out of this account. Just remember, though, it's harder to get it back in. The allocated pension has no tax on investment earnings. So that could be an increase in your returns of 1 to 2%. That really can add up over time. And don't forget, you can also take a lump sum. The Retire Choice product is appropriately named because you actually have a choice of investments. In fact, you have to make a choice. You can no longer have the default investment option in this product. There's a number of diversified options. They have a variety of asset classes in them. The shares is included there because it actually has Australian shares and international shares. If you would prefer to build your portfolio, though, with single asset classes, for whatever reason, maybe you have shares outside super and you decide you don't want so many shares inside super, there could be a reason you want to build your own portfolio, so that's possible as well. Our RetireSmart product is an award-winning product. I guess it was evolved to make or to reduce the risk of people drawing down their capital during periods of volatility, because especially in early retirement, that can have significant long-lasting impacts. This product has a cash bucket that pays the pension payments out. The growth assets sit to the side and have more volatility, but you're not drawing down from those assets, so there's less risk of crystallizing losses. But the pension bucket tops up when it gets too low. So this product is automated. We can also replicate this cash bucket strategy in the Retire Choice product because this RetireSmart product doesn't suit everyone. It may be too risky for some people or not risky enough for others. So if you are interested in this strategy, particularly at the moment, there's a lot of volatility in the markets, this is something we can look at for you.
All right, Sonia, I think I'm alive again for the moment.
Oh.
We're moving. I have a couple of questions that have come through via the Q&A, and I'll come to those once we get into the Centrelink question. We've got a question here from Chris that I will ad-lib a bit and summarise and hopefully answer that question. But we're now moving into, the assessment criteria for Centrelink Age Pension.
Okay, we have to reach age pension age. There are some people under 67 that are that are born before 64 that have different age pension ages, but eventually it would be 67 across the board. You have to be a resident of Australia for 10 years or more, although there are some special rules for Kiwis. And then if you tick those two boxes, then we look at the asset test and the income test concurrently, which we'll go into further, and then we're going to look at payment rates. There we go. So beg your pardon, that's 1957. If you're born before there, you may be able to start at the age pension at 66 and a half. 67 is going to be the standard though for us going forward. Alrighty, the asset test for an individual. We have three colours there. The mauve is representing people with assets under the lower threshold. We're talking about financial assets. They don't include your home. There are other exempt assets too, like funeral bonds up to $13,500 and components of annuities. If you have assets between the lower threshold as a homeowner, that's $270,000, and the upper threshold's $599,000. If you're in between those, you'll get a part pension under the asset test. If your assets are over that, you won't be eligible under the asset test. As a non-homeowner, the theory is that you have rent to pay, so they're a bit more generous with the thresholds. We're going to then have a look at the income, for the couples, we have different thresholds. They're not exactly double because a couple's expenses aren't exactly double, but the important thing with a couple is there are some strategies we can do to reduce assets where there's an age differential. So if you have a partner that's under age pension age, then perhaps you can leave their super in accumulation phase and it won't count as an asset. There are some strategies then also for building up the younger partner's super assets, and therefore having less assets count towards the asset test. So the older person may be eligible for more Centrelink Age Pension. So those strategies can really add value over time. And the more age pension we can be eligible for, the less of our own money we have to use in retirement.
I might jump in here, Sonia, because you pretty well guessed the question that's been asked. So assuming we have a member who is age pension age and receiving age pension, wife who's currently 65, not eligible, is retired and not eligible to receive the age pension yet because of age. They have a pending purchase of a property, and obviously wanting to know how can they use their super and bank account balances to maximise their Centrelink benefits. So you've pretty well sort of summarised that in that statement that you just made there, but it might be just worthwhile to repeat it.
Yes, so a younger spouse, not yet age pension age, can keep their super in accumulation phase. Perhaps they have to just because of age, but having money in accumulation phase means it's not counted as an asset until the younger spouse gets to age pension age themselves. With every strategy, though, there is a benefit and a risk. The cost of putting money or keeping money in an accumulation account is that you don't get the tax-free earnings. So the younger spouse at age 65 could have an account-based pension, could have tax-free, then have tax-free earnings. We weigh up the differences. Is the benefit of the age pension going to outweigh the tax savings? And that may not be the case. So every situation should be reviewed based on the particular circumstances.
Thanks for that, Sonia. And I suppose, Chris, someone from our organisation will reach out to you and provide further information in regards to that as well, if you've got any subsequent questions. But just a reminder for those, if they do want to ask any more questions, the Q&A facility is there. So you've covered the asset test, Sonia. Now we need to go through and, I suppose, have a look at the incomes test.
Correct. So you might get a tick for the asset test, but maybe not the income test, or vice versa. The income test includes earned income, it includes deemed income on your financial assets, and it could include rent income from any rental properties that you have. There might be defined benefit pensions that come in as well. The majority of people, though, will have age pension determined by the asset test. It's important to see this income test because if one member of a couple is working, that could knock out the income test, and we look no further. However, if somebody is working in their age pension age, there are some concessions. So the first $300 that people earn every fortnight is not going to count towards the income test if they're age pension age, and likewise for their spouse. We have deemed income that will be deemed on money in the bank, shares, managed portfolios, and account-based pensions. But for somebody under age pension age, their financial asset won't be deemed to earn any income. So there's all sorts of strategies around adjusting income that we use to get people over the line if necessary. But you can see that the test is quite generous. You can, as a couple, earn $85,000 before you lose the age pension.
Significantly generous, I would suggest.
Mm.
I suppose moving on is, well, you've gone through the two tests and the worst result provided. What would you be likely to be receiving? So these are the current rates of age pension.
Whilst, as a rule of thumb, in retirement, you need about 70% of the income you earn during your work life. A lot of people will look at these figures and say, would I be able to meet my costs of living? And some people actually can. They can actually save money while they're on the age pension, but most people are going to need a little bit more if they have the modest or comfortable lifestyle. If you can see that the couple income is nearly $39,000. If only one person is eligible for the age pension because their age pension age and their spouse isn't, the maximum they can earn is the $19,300. But that's still, if you can be eligible for that amount, that's $19,000 of your own money you don't have to spend.
And then I suppose what other discounts or available options are available for these pensioners?
This is the Commonwealth Seniors Health Card, which I call the cousin card to the age pension concession card. I know people would cut off their arm to get the age pension concession card, but if that's not possible, have a look at eligibility for this card, which has an income test only with a higher threshold. And the Labor government has also said they're going to put the thresholds up. So watch this space. The income, again, that is included towards these tests is earned income, deemed income on financial assets and any rent and defined benefit pensions. You have to be age pension age. You have to meet the residency rules, but it's still going to give you some cheaper pharmaceuticals, bulk billing at the doctors if the doctor allows it. And some people will even tell me they get discounts on their utilities, which can save hundreds over the year. So there we go, and discounted public transport. That all adds up.
And now we're going to go through, well, what are the rule changes from 1 July? It used to seem like an eternity away, but it certainly snuck up very quickly on us. I suppose the one thing is that if you're a current pensioner and receiving pension income, we mentioned before that if you're in and receiving a pension, you must take out a minimum. Under the current legislation, the minimums are set at percentage levels. The government has allowed a 50% reduction for the past 2 years, and they've advised that that's going to go forward until June 2023. The $450 threshold whereby an employer must make super contributions is being removed. So basically anyone now who's a low income earner and earning less than the $450 a month will be able to receive the standard compulsory employer superannuation rate. From 1 July, that is actually increasing to 10.5% for all employees. Sonia went through and quickly mentioned the changes to the work test. So for those people aged between 67 and 74, there's no longer the work test rule to contribute to superannuation. So I would imagine, and I've already received a few phone calls about, well, 1 July is fast approaching. When can I make these contributions? So I would imagine that, you know, the many years that we've been doing these seminar presentations that we've told people that, well, no, you can't contribute to super because you need to meet a work test. This has now been changed. So essentially a lot more people, and I would expect, Sonia, you've probably had some clients of yours that are in this category that are now prepared to put more money into super to eventually get into a more pension account. Would that
Absolutely. Yes, it's an exciting time. It's going to be a busy time. I do need to clarify that a work test will still need to be met if you're making a personal deductible contribution. So that's important to just check you've done the 40 hours in a 30-day period.
Certainly. And certainly the other change was that surprisingly they allowed the bring forward rule as well. So where I mentioned that you contribute up to $110,000 a year and bring forward 2 other years and contribute $330,000, providing you no longer can contribute, we can actually use that bring forward rule right through till the age of 75 or up to 75. It's very important. Once you turn 75, that's certainly the door is closing. So certainly there are some changes in your superannuation world in terms of contributions, and I would suggest that if you want further information, you can give us a call. The other thing is that the downsize of contributions, Sonia mentioned it, it's going from 65 down to 60. So people who are selling their home, they can certainly contribute those downsize of contributions earlier. And the one thing that they've tried to make sure first home buyers can now save up to $50,000. I think previously that was $30,000 under the current rule. So certainly if you've got some people out there that are looking to save for their first home, they can actually use or make contributions to their superannuation account, put them into that tax concessioned environment. They can then draw back on what they've personally contributed up to $50,000 in order to purchase their first home. So certainly quite a great feature for people to get into their first home. I suppose, Sonia, would you mind running through the importance for your clients that you've seen as to ensure that their estate planning issues are all sorted?
Absolutely, Paul. It's an important area. We want to make sure people get their assets to the right people at the right time and minimise tax on the way. So we do ask people what their goals are, and we know that 50% of the population don't have a will in place. So to make sure that your desired beneficiaries do get the money, a will's important. We know that superannuation doesn't necessarily get governed by the will, though, because it's in a trust structure and the trustees of the fund decide where the money goes. You can direct them where to send the money with a binding nomination or a non-binding nomination. The binding nomination, however, locks in your decision so that there's no discretion on the part of the trustee. So there's pros and cons to that. but we look at then what tax impacts there are going to be as well, depending on what assets you're leaving to your various beneficiaries.
Yeah,
The enduring
and-
power of attorney is another important document that we need to consider.
Yes, certainly. And we always remind people to ensure that they have a review their nomination of beneficiaries on their account with the fund. That has been provided on their annual statements. It's also online. You may want to review if you wish to have a binding nomination. There are differences, and I would suggest that if you do want to make a more, I suppose, secure, confirmed beneficiary that does not need to go through a review like a nomination does, then I would suggest a binding nomination may work for you. The drawback is that you need to review or remake this binding nomination every 3 years. But I would suggest if you want further information, you can give us a call on that one.
That renewal process has become easier as well because there is a simple form to refresh your nomination if the beneficiary is not changing.
Yeah,
that's
correct.
a brand new form.
Yes.
So that's exciting.
Sonia, I think this is best for you to answer this one, on how you can actually assist a member in terms of retirement planning.
Absolutely. We can help answer questions. We can help tune out the noise. There are so many rules. We find that people just get frozen with action because they don't know where to start. So we go through the process of meeting with people, looking at what they want and need. And I'm only going to assist people if I can, hand on heart, put them in a better position. And I think the feedback is that the strategies we assist people with give them some certainty, save them tax, help navigate through very complex legislation, and who doesn't want to be put in a better position? We importantly can help non-members of the fund. We advise on a wide range of topics, whether that's redundancies, disabilities, estate planning, Centrelink, looking at rollovers from other funds. We have to be able to advise on many products to be able to give that holistic advice that we talked about. We're all accredited for aged care advice as well.
And I suppose, Sonia, that the first step, if you just want to reach out and receive some general information, there's our call centre, but also there is our regional manager team. Now, I'm the regional manager for the Brisbane office. I would be able to help you with provide just general information and then provide you with probably assistance with completing forms and basic information on your account. However, if you wanted a recommendation, that this is where the advice team comes into play. And you have two options. We have what we call an over-the-phone advice service, where a team member can call you over the phone or through Teams, and then they can basically assist with you, how much can I contribute to super and what form should I contribute to super, what investment options are available, insurance, how much insurance should I have, and obviously looking at the transition to retirement. Now, that's at no further cost to you. It's all part of inclusive of your membership. So if you do wish to seek advice down that path, and I've often suggested to people that it is, if you've never experienced working with a planner, then maybe looking at one of these items is a great first step or start for your retirement planning journey. The problem is with these planners, as it says, limited. So it's limited to these 4 items. And there's nothing to say that you can have all 4 if you wanted to. But if you wanted what we call a more comprehensive or holistic review of everything, including that of your partners, and ensuring that you've got the best situation possible to your personal circumstances. And with that comes what I call a life-changing strategy document that you get. You can put it under your pillow and absorb it every night if you wanted to. This document basically goes through ins and outs of all of the items to ensure that you're properly prepared. And that's where Sonia and the comprehensive advice team can assist you through that process. So I would certainly recommend that if you're getting to the point where you want I suppose, a little bit more care, a little bit more self-help, a little bit more help and assistance to guide you through that. And as Sonia said, eliminate the noise, then I'd certainly recommend the comprehensive advice model to you. But there are other options available to you. Sonia, did you have anything further to add in terms of the service and what's the process?
We do require a little bit of initial information, just to the extent that you're comfortable with. And then we have a meeting to have a look at what you want and need. And there's no charge for that meeting. So at that meeting, if I find that there are areas I can help, I'll let you know, and I'll give you a fixed price quote, as will the other advisors. And there's no obligation to go ahead with any advice. We're not on commissions at any level. We do have legislation to make sure we're only giving advice that's more than likely to put you in a better position, whether that's financially or non-financially. And so we are very aware that you know, that imperative is there, but it's only going to cost you 2 hours of your time initially, and I think it's worth doing.
Yes, certainly. And as I know, and I've seen family members that have gone to you, Sonia, by getting a document and getting their full financial review, it's certainly given them a bit more peace of mind. So it's certainly worth the effort. I suppose in regards to your account with the superannuation fund, I've got a couple of questions there, Sonia, that we'll go through. But just remind people that if they do want to ask a question, there's the Q&A facility, and then we will answer those in a moment. In terms of the member portal, if you do want to seek further information into your account, I would suggest that you log on. Now, obviously, we need to have your mobile number and your email address for you to go through that process. And if we have got that on file, you should be able to go through the online facility and go in and have a look at your account. And that can give you basic information about your nomination of beneficiary, whether it's binding or not, your investment options, and the historical performance of the fund in your account balance. So it's certainly worthwhile having a look. We've made some significant changes to that. You can certainly make a contribution, change your investment options, have a look at your insurance account, insurance benefits that are there, and you can even start the process of making a claim. So I'd certainly recommend that you have a look at our portal. What can you do right now? I suppose there's a couple of items that you can do. I would recommend just having a quick look at your account. You can either do that logging in, or if you don't want to do that, the regional manager team can assist you in going through that, ensuring that there's items covered off. But I would also recommend that you speak to the financial advice team. And I suppose, Sonia, we have had one question already. How do we access the comprehensive advice service? So I would imagine that the best way to do that, you'll be giving a survey at the end of this session. You can click on that. If you wish to seek advice, you can go through that process, or otherwise our contact details, 1300 658 776, or our fund office address, if you wish to seek that advice. But what we will do is that if you've asked a question today, we'll get part of our regional manager team for your area to give you a call, and then they can discuss with you, and then they can certainly put you in contact with your local financial planner. So Karen, in regards to your question, we will certainly be getting someone to give you a call if that's what you want, but otherwise there are other forms that you wish to, get into contact with that service. Michael has asked a question in regards, Sonia, to two accounts. So let's presume they're retiring at the end of the year. Is it better to combine into the one account to save fees, etc., or just to have one each?
Great question, and it really will depend though on your personal situation, because you might have insurances in each fund that you want to keep, or there might be a reason to have two accounts for estate planning purposes. But it's worth looking at because there could be fee savings, and the simplicity of having just one account going forwards could make a big difference. When you come to see us, we compare and contrast products to find the product that's going to meet your needs best.
Bill also asked a question in regards to when do you need to go and get the advice? He's retiring in 2 to 3, 4 years' time. Should he wait until a year out, or should he more be receiving advice ASAP?
ASAP, and not because we need the work. We absolutely believe that getting strategy advice well before retirement is going to make a significant difference for 4 years' time.
Lovely. Okay, well that ends our session for today. It was certainly a very quick run through. I apologise for disappearing every now and then, Sonia. I'm hoping that I was going to be more around for this seminar, and I thought I was in better health than what I was. So thank you for stepping up.
You did well under the circumstances.
Thank you for covering for me. But if anyone has any questions, certainly reach out to the 1300, or if you know of a regional manager, you can find their contact details on our website. But certainly for those people that have asked a couple of questions, I will get people to give you a call in that area to see if you've got any other further questions. But thank you all very much. For the Queenslanders that have joined us today who are on holidays, I hope your holiday is going well. For those of us that are still working, keep chugging along. I must admit, Sonia, we've only got 2 more days to the end of the financial year, so I'm sure we will survive.
Yes, happy end of financial year, everybody.
Yes, all the best, and thank you very much for attending today. All the best. Bye.
Bye.